makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The rally in global equities that pushed the S&P 500 to a record high continues. This week, investors set their sights on the ECB, the Bank of Japan, and, of course, U.S. GDP data. A major boost for Donald Trump as Ron DeSantis bows out of the U.S. presidential race, saying he sees no path for victory. The spotlight is now on tomorrow's New Hampshire primary. Plus, Sony calls off a $10 billion merger with India's Zee Entertainment. The deal would have created a media giant with the financial muscle to take on Netflix and Amazon. So good morning, everyone. Let's take a look at the European markets map. Of course, a lot going on in some of these markets. It's very clear that the S&P 500, since hitting a low in October 2022, has surged some 35% and has topped that over the last couple of days. Now, what we're looking at is actually European stocks, but also Asian stocks a little bit earlier on, extending the rally in global equities. Once again, that pushed the S&P to a record high on Friday. So you see the FTSE gaining some 0.2%, the CAC 40, one of the biggest gainers in the European market session, actually gaining 0.7%. So we go to politics, and Ron DeSantis has dropped out of the race to be the next U.S. president, endorsing frontrunner Donald Trump. Now, the departure of the Florida governor leaves Nikki Haley as the only major rival to the former president for the Republican nomination.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
Well, for more, I'm joined by Bloomberg's Bill Ferry. So, Bill, this was pretty extraordinary. What does DeSantis' endorsement of Trump actually mean for Nikki Haley's campaign?
Well, it's going to be very interesting to see how much of a slice of those DeSantis voters Nikki Haley can peel off. We know from polls that were done before this announcement that many of those DeSantis supporters viewed Donald Trump as their number two choice. So I suspect he'll get the majority of them, but that Nikki Haley will get some. It is, as you said, basically a two-person race at this point between Donald Trump and Nikki Haley. And it's critical for her to try to get some momentum coming out of New Hampshire, heading into the next big primary race, which will be almost a month from now in her home state of South Carolina. But she needs a good showing this week to get all the way there.
Bill, I keep on being told that actually New Hampshire is a little bit different because it's almost like, because it's a purple state, it's a little bit like a national election reflection. It's not really what the Republicans would vote for.
Yeah, well, the very interesting thing about New Hampshire is that in the Republican primary, they allow people who are not registered Republicans, people who are either unaffiliated or independent voters to take part in the primary. So Nikki Haley has, among other things, been trying to reach out to those folks and try to get them to turn out on Tuesday. That gives her a little more reach with kind of moderate independent voters. Whether that's going to be enough to close the gap with Trump remains to be seen. She really wants to come out of this, ideally with a second place finish in the single digits or the low double digits. There are some polls showing her as much as 18 points behind. That's not going to be a great showing for her trying to sustain her campaign for another month.
All right, Bill, thanks so much. Bill Ferry's there with the very latest on the U.S. presidential election. Now let's get some market insight with our guest. Joining us now, Hannah Smith, Vice President for ETFs at State Street Global Advisors. Hannah, always good to speak to you. Thank you so much for coming on. If you look at the markets, they don't have a care in the world. If you look at the S&P, it's at a record high, and European markets are following. What do you worry about? Is it policy or actually politics changing the route of economics?
Well, firstly, good morning, Francine. Great to see you. As you mentioned, the markets have been sort of going along blissfully in respect to some of the geopolitical risks and other things that we've seen within the markets. But I think if you actually look under the hood, there hasn't been a huge amount of momentum. The S&P is up 1.5% over since the beginning of the year. But if you compare that to the end of last year, where it was up 16% in the last couple of months, it hasn't really moved that significantly. And all of the drivers are the big tech names as well. So I think there is still quite a lot of caution off the back of some stronger than expected US inflation numbers, and also I guess, mixed with some of the stronger consumer data coming out of the US as well. So it's sort of mixed data, but the market is moving still quite close to sort of benchmark.
So, Hannah, if you look, I guess, at the driver going forward, is it 100% earnings, given all the fluctuations that we've had so far? Is given this kind of economic, trend, whether the corporates are strong enough to withhold them?
Yeah, I think earnings is definitely going to be one to watch going forward. And I think what we've seen is that whilst the market has really taken on board some of those lower inflation numbers, the consumer really still remains strong, as does the labour market. So I think this is a real dynamic that needs to be watched carefully in terms of indicating when rate cuts or the path and the rapidness at which we see rate cuts. So I think the markets is really holding on to some of that positive data and obviously factoring in expectations of a soft landing. But it's still very much market and data dependent.
Do you worry that actually even if we get cuts from the Fed, all of the good news has already been priced in?
I think that is a big concern, honestly. If you look at S&P being at highs not seen since January 2022, the market's really been quite optimistic. And so I think, yes, a lot of good news has been priced in. But interestingly, if we look at investors, there still is quite a lot invested in cash, so on the sidelines, which still could be put to work within the markets. And also a lot of the equities where we've seen inflows have been into the more defensive sectors. So whilst the markets have moved quite positively, if you dissect that a little bit deeper, there is still some caution within investors' minds.
So how do you basically, what do you buy right now? Is US still, the main thing to look at?
Yes, exactly, definitely. I think I've been quite consistent in wanting to stay defensive within equities. So the US, large caps, really those are the companies that if we do enter a recessionary environment, even though it's not the base case, there still obviously is quite a lot of data that is dependent. We're data dependent in terms of rate cuts and where to go from here. So I think staying US, large cap, also defensives, healthcare, and tech as well, which is a no-brainer given the current environment and what we've seen tech do last year and year to date.
So you also have a really interesting China call because you're tactically overweight China.
Yes, exactly. I knew you were going to ask me about that. So yeah, China, as we've seen, China has been extremely challenged and there's not a lot of strong momentum around China. But if we actually look at how China's traded, it's really been punished by the markets. And we think a certain extent of that is overdone. And given the more risk-on sentiment that we've seen coming into 2024, we think it could be an interesting entry point. Now, that doesn't detract from a lot of the concerns around China, but if you look at it from a valuation perspective, it really does look like it's overdone and it's sold off 16% year to date. So that's quite significant. And I think for investors who are willing to take a little bit more risk, it could be a bumpy ride, but this could be an attractive entry point.
So how are you expecting China to, it's quite difficult to see exactly how they reopen and what they do with the property market. So is this more like a 12-month, 24-month play?
Yeah, exactly. I think it's a longer term play and it's really quite tactical in the sense that it is very undervalued at the moment. And as I mentioned, there are going to be bumps along the road and obviously we're watching closely what policymakers do within the region. But for investors who do have the risk appetite, I don't think it's one that can be overlooked in terms of how significantly it has sold off and some of those valuations. On the debt side, it's trading at within the 60th percentile. So it hasn't been cheap a significant amount of time, more than what we're seeing now.
All right, Hannah, thanks so much. Hannah Smith from State Street Global Advisors stays with us. We'll also talk a little bit about Europe and maybe delve into some of the smaller caps. Coming up, Germans take to the streets to protest far-right extremism and the rise of the anti-immigrant AfD party. We'll have more on that live next from Berlin, and this is Bloomberg. Welcome back to The Pulse. I'm Francine Lacqua here in London. Now, still with us, Hannah Smith, Vice President for ETFs at State Street Global Advisors. Now, Hannah had this pretty amazing call, actually, being tactical overweight to China, which, of course, caught my eye. But actually, all of your calls catch my eye because I know you're also, for example, you prefer the large cap versus the small caps. I just wonder whether there's an effect at some point where we start, questioning, for example, valuations of the Magic 7.
Yeah, I think it's an interesting point, and the reason that we prefer large caps is because of the concerns around, are we going to have a soft landing versus a hard landing? As we are moving now into the soft landing camp, I think that does give support to small caps, and it means that some of the pressures that were exerted on them before are less prevalent in an environment where we go into a soft landing. So I think it's definitely large caps at the moment, but as we do enter into this soft landing environment, that could provide an opportunity for small caps.
Hannah, what do you do with Europe?
Yeah, Europe's an interesting one. I think if we look at it from an investment perspective, it's very cyclical. And as I've mentioned, defensive is really where we want to be when there could be bumps along the road. So I think Europe has a lot of headwinds at the moment. In particular, Germany is looking quite weak. It's relied heavily on China. China's becoming more self-sufficient. So I think Europe is one to avoid for the time being.
At some point, does it look like a good valuation, or does it still have a lot further to fall?
I think it's one to watch. I think at the moment it's not looking overly attractive, but as we see what happens in regards to this soft landing, in inflation numbers as well, it could be a point at which we reassess and say it could start to look more interesting. But at the moment, that's not the case.
And you also have a great breakdown looking at sectors, saying, look, you prefer tech and healthcare sectors, again, as a recession hedge.
Exactly, yes. Healthcare is really well positioned. It's a defensive sector. It also has very high cash as well, so that's positive for it. It's very under-owned and people are underweight it. So we feel that it's well positioned, and we think that there's going to be positive earnings coming out from healthcare as well. And then we barbell that alongside tech, which is obviously more cyclical, but it has huge cash piles, which means that rising interest rates are actually positive for them. So we also like tech as well, and obviously the earnings have been phenomenal for tech as well. So we think a combination of the two is a good sort of hedge for investors.
And I also want to get your take on fixed income.
Yes.
First, let's listen into what Christine Lagarde told us last Wednesday before she was in a quiet period.
I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored at the level where we would like to see them.
So this was Christine Lagarde actually pushing back against some of the market expectations of increase or of rate cuts. What's happening in the market? They seem to be wanting those cuts so much that sometimes everything's priced in, and I don't know whether it forces policymakers to do something or whether it's markets that will end up being disappointed. Yeah,
I think it's a really good observation. And what we really see is whenever there is data which supports a rate cut narrative, the market really gets ahead of itself. Yeah. And so then it's at times like now when we've seen the performance of the S&P, it's up 1.5% year to date. There's not really much further for it to go since it closed at record highs. We're now experiencing even more highs. So some investors are looking and thinking, the market's not doing too much, but it's actually already, a lot of it's already been priced in. So I think it's a delicate balance between the market obviously being supportive when we do have positive data coming out, but not getting carried away with itself. So we've been focusing so much on geopolitics, yes, and actually the fact that there are so many crises and we're on the brink on so many places. And then I have a big investor that messaged me yesterday saying, actually, I think it's the biggest concern is a monetary policy mistake. Mm-hmm. Is it really, or is it just geopolitics that we don't really know what kind of economy we'll be dealing with, and so it's very difficult for monetary policy to know what to do? Yeah, it's a great question. And I think this is where we have seen many of the central banks come out and really push back on this narrative that we're going to see these huge rate cuts coming into 2024, because it's also their job to sort of temper the sentiment around how many rate cuts we're expecting. But it's an interesting point about geopolitics, because we haven't really seen the market react off the back of the multiple shocks that we've seen year to date. We do think that might change, and it's very hard to ignore some of the significant conflicts that we have at the moment and the impact that those have in the market. Thank you so much, Hannah, as always, for joining us. Hannah Smith there, Vice President for ETFs at State Street Global Advisors. Now, hundreds and thousands of protesters have also taken to the streets in Germany over the weekend, rallying against the rise in far-right extremism and popularity of the anti-immigrant party, the AfD. Now, to discuss all of this, let's also go to Bloomberg's Oliver Crook, who's live in Berlin. So, Ollie, what's at the root of the protests, and what's the wider context of them set within German politics right now?
Yeah, exactly. There's a sort of spark, and then there's the powder keg. And the spark is in the form of this meeting that we understand took place in November. It was reported on just 2 weeks ago, which senior members of the AfD, but also members of the CDU attended, where there was this sort of plan about remigrating millions of people out of Germany. What does remigrating mean? So there's the deportation of illegal immigrants as one part of it, but also talking about people with immigrant status in Germany, and even those who are German citizens who have an immigrant background that have not, quote unquote, assimilated sufficiently to get them basically to leave Germany. And so this obviously brings the echoes of one of the darkest periods in German history. And so for many people in Germany, a party like the AfD has no place in mainstream politics. So they took to the streets. And the reason that it is so urgent now is because the AfD is at 23% of the polls. It is the second most popular party here in Germany. We should say that the AfD has sort of stepped back from the language around this remigration controversy, and one of the advisors to the co-founder who attended the meeting has stepped down. But still, for Germans, many of them, there is no place for the AfD in mainstream politics. The issue is this: what does the protest actually achieve? Yes, it sends a strong signal. Many people in Germany would like to see the AfD banned as a party, but of course, and there is a provision in the German constitution to ban parties if they're a threat to democracy, but you can't ban parties just because you don't like what they're saying. And of course, the AfD would say that that is undemocratic, and of course, it would be. So this is really at the center of a tension that is really boiling up within Germany that we're going to see play out over the next few months ahead of September state elections, where the AfD is expected to sweep all three of the elections.
Ollie, thanks so much. Oliver Crook there with the very latest from Germany, and we'll have, of course, plenty more throughout the day. Now, coming up, the Israeli Prime Minister Benjamin Netanyahu under mounting international pressure for rejecting Palestinian rule of Gaza after the war. We have the details, and this is Bloomberg. Israel's Prime Minister Benjamin Netanyahu has rejected what he calls unacceptable terms presented by Hamas for a new hostage deal. And it comes as the Israeli leader faces increasing pressure at home and abroad over his handling of the war with Hamas. Now let's get the latest with Bloomberg's Mark Champion, our international affairs columnist. So, Mark, over the weekend, President Biden spoke to Prime Minister Netanyahu for the first time in almost 4 weeks. What is the current state of the Israel-U.S. discussions over Gaza?
Well, I mean, you'd have to say they're in trouble. Essentially, when Netanyahu was in Washington, he made very clear that he and the U.S. administration disagree on what should happen in Gaza now, and more specifically, what should happen after hostilities wind down. He made it very clear that he's not interested in any kind of Palestinian state. And that he is, willing to see, thinks that it's required that Israel should remain security control over the Palestinian territories, essentially, which would essentially mean military occupation. So there's a wide difference now between the U.S. and Israel on, how to handle this crisis, and that's going to play out over the coming days and weeks.
So, Mark, what are some of the pressures facing Netanyahu at home, but also abroad? It seems the tide is turning.
Yes. So at home, on the one hand, he's correct that most Israelis really have no patience to talk about a two-state solution for, the Palestinians at the moment. But on the other hand, there is rising pressure to do something to get the hostages back. And to end the war. So there is, you had someone from within his cabinet, very respected general called Eisenkot, who, last week gave an interview in which he said, we're not winning in Gaza. Victory means the elimination of Hamas. And that if anyone who says that is lying to the public. Which is pretty tough language, and that is exactly what Netanyahu is saying, is that we need to continue this till victory, we can do it, and that is compatible with getting the hostages back. In fact, he says it's the best way to get them back. The families of the hostages profoundly disagree and are now protesting, including outside his home, and saying that, we need to make a deal of some kind with Hamas, And that's where the statement that he had over the weekend comes in, where he said that the terms that Hamas is asking are unacceptable.
Mark, we've also had some comments from the White House on the use of a deterrent strategy in the Red Sea. So how is this campaign going?
Well, it's going as one could only have predicted. In essence, the U.S. is very good at finding targets, eliminating them. It has the most sophisticated weapon systems in the world to do so. The difficulty always was going to be, and has been, in Iraq and Afghanistan and elsewhere, how do you really change the behavior and control what is in essence a guerrilla formation? They have mobile missile launchers and have said very clearly that they're not going to be impacted or dissuaded from their campaign against international shipping by being targeted. In fact, if anything, they seem to quite have invited this. So it's a difficult position for the U.S. The U.S. is saying, look, this is a wider policy of deterrence. It's not just directed at this particular moment, and you need to be patient.
Thank you so much, Mark Champion, there with the very latest on the Middle East. Well, the rally in global equities that pushed the S&P 500 to a record high continues. This week, investors set their sights on the ECB, the Bank of Japan, and U.S. GDP data. A major boost for Donald Trump as Ron DeSantis bows out of the U.S. presidential race, saying he sees no path for victory. Well, the spotlight is now on tomorrow's New Hampshire primary. Plus, Sony calls off a $10 billion merger with India's Zee Entertainment. The deal would have created a media giant with the financial muscle to take on Netflix and Amazon. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Singapore Exchange is continuing in its efforts to increase the number of IPOs on the exchange. It will be hoping for a better year after a decline in 2023. Now, I'm pleased now to be joined by Boon, Chye, the Chief Executive Officer of the Singapore Exchange. Thank you so much for making the time of actually coming on air with us. First of all, sir, what are the kind of steps that you're putting in place to try and revive the IPO market for 2024?
We've done a number of things over the years. First of all, obviously boosting the research ecosystem, reaching out to the retail and institutional investors, and more importantly, the wider Southeast Asia markets. And we've created connectivity with some of the exchanges, such as Thailand. We've also linked up with the two Chinese exchanges in terms of ETF linkage. That's all to bring flows into Singapore to create a better ecosystem for companies looking to tap the capital markets.
So are you confident that actually you have a good pipeline? I know, some of the SPACs decided not to list in Singapore. I don't know whether they were worried about more market conditions than the actual place of where they would be listed.
Well, I think, first of all, we need a more conducive market conditions. It's not just about inflation, but let's not forget that rates are at a higher absolute level. At one level, it's interesting to look at the pipeline, but I think when market conditions are more conducive, even those companies that have not been on a pipeline, I think will be thinking hard to try and raise capital.
I think the Singapore Stock Exchange, of course, is competing with Hong Kong Stock Exchange to come up trumps, also looking for business away from Asia, but, for example, from the Middle East. Are you confident that, for example, secondary listing of Chinese firms will be part of your story in the future?
Well, for the Singapore Exchange Group, we are multi-asset marketplace, multi-asset platform. Not only do we have a stock market that caters to a company looking to raise capital, we now have a very broad, growing and significant derivatives business in equity, derivatives in currencies and commodities. And that really allows investors to access Asia through a very efficient single point of access.
Yeah, and looking at the numbers, some of the currency, but also some of the commodity derivatives are doing very well, quite well on your exchange. So how much growth are you expecting in those categories?
If you look at when we first started to financialize the iron ore contract as a proxy for global growth, The volumes have actually doubled in the last 4 years. More significantly, we now have many more financial players participating in the marketplace, and also liquidity is now almost round the clock into the New York session. We continue to see growth because we think Asia continues to lead Asia growth globally.
Globally, I mean, where do you see when you look at listings or some derivatives? Where is that growth coming from? So are there certain sectors, for example, in IPOs, that you think will lead the way? And are there certain parts of the world in terms of currencies that you think will lead the way?
If you look at Southeast Asia, 10 years ago, we hardly had a few unicorns. Part of the IPO story is also supply. Today, Southeast Asia could boast of 80 to 100 unicorns. And when market conditions are more conducive, companies will come to the market, coupled with the fact that we do have a very effective single point of access into Asia that is continuing leading global growth. That allows participants to obviously trade the whole of Asia through the XGX group.
So who do you think right now is your biggest rival? I know you're trying to get business from the Hong Kong Stock Exchange. What about the LSE here in London? Has Brexit changed the appetite, I guess, for listing in the UK, and can you take advantage of that?
It's counterintuitive. As an exchange for Singapore Exchange Group, we probably have more collaborations with many other exchanges, many other marketplaces than any other exchange group in the world. Our deposit receipt with Thailand, more will come with the other markets, connectivity to China. And I think exchanges are probably better by collaborating to create a bigger marketplace.
You must be in rivalry, though, right? I mean, if you look at London, do you think Brexit has changed London listings?
Well, London has historical significance, obviously strategic geographical location, coupled with enduring resilience. I'm sure that over time you will have a new model for economic growth, and London remains a very important capital markets.
So Treasury income actually gave a big boost to your 2023 fiscal year earnings, right? Thanks to higher interest rates. What are you expecting for this year as interest rates go down?
We are a very diversified business model, so as rates normalize over the next 12 to 24 months, trading activity, I think in particular the stock market will probably increase, coupled with the fact that Asia continues to lead global growth. There will be flows, financial portfolio flows into Asia.
So you also have first half earnings next week. What should we be looking out for? Is there anything particularly exciting that's coming up?
Watch out for the result next week.
Can you give us, what are you most excited about over the next 12 months, 12 to 24 months? I know you're also here to muster business. You're here for, maybe changing technologies and things like that. But what personally are you most looking forward to?
The growth of Asia. I mean, Asia is complex, but it has got many countries. You have the economic powerhouses of China and India. You have the developed markets of Korea, Japan, Taiwan. And you also have the hidden gems of Southeast Asia. Southeast Asia by itself is half the size of the United States, but twice the number of people. So tremendous opportunities in Asia, and we're very optimistic around the growth in Asia.
There are a number of elections, of course, coming up, not least the U.S. election. Do we need to wait post-U.S. election to have, I guess, more certain valuations? Or when you look at the market uncertainty, will it be easier post-November?
Well, I think geopolitics is clearly, and elections is one of the consideration, one of the factors. Yeah. But for an investor, they need to allocate. And I think in a diversified portfolio, you have to just price that in. Okay, thank you so much for joining us. That was a great conversation. The Chief Executive Officer there of the Singapore Exchange, Boon, Chye, joining us this morning. Now, coming up, we're joined by the Chief Executive of Edelman to discuss their latest trust barometer. The conversation with Richard Edelman is coming up next, and this is Bloomberg. So rapid innovation is fueling distrust. That's one of the top lines from the latest Edelman Trust Barometer. The 2024 report says society's ability to process and accept rapid change
is under pressure. And when it comes to the biggest innovation of our time, AI, initial findings show that most people will resist its use if they believe the change is being managed badly. Well, let's discuss all of this with Richard Edelman, the chief executive of Edelman. Richard, so good to have you here in the studio. I know we both survived Davos, just about.
We're here.
And that was also talking about trust, but mainly between, politicians, corporates, and actually citizens. I mean, AI changes everything.
So if you walk down the promenade in Davos, you saw company after company promoting AI. And the instinct is to say, oh, it's the savior. And of course we want economic growth, Francine, because growth drives trust. And the developing countries have higher trust levels than developed because they have higher growth rates. And so AI should fuel growth. The problem is, by 2 to 1, people think that it's being badly managed and that it's being forced and rushed and not particularly well regulated, and they don't understand what the benefits are to them, and they're not quite sure what it means for employment.
But so what are your worries about AI? Is it that we're going too quickly and that it could actually put up some forces of evil in it because we don't know the end use, or does it lead to job losses?
It's job losses, but it's also, we have 50 elections this year, and who knows what it does for the democratic process in terms of disinformation. And we have to be quite sure that people get accurate facts in order to make the right judgment on the candidates.
Yeah. What I thought actually was really lacking in a lot of the conversations on AI is that it also touches a percentage of the population, and it probably widens the gap between the haves and the have-not when it comes to AI adaptation.
Well, interestingly, across gender, across countries, across education levels, income levels, everybody is nervous about AI. But in the U.S., you already see this mass class divide about AI, 20 points delta between the high and the low. And between Republicans and Democrats, shockingly, not just for AI, but for EVs, for green hydrogen, like this, it's 40 points difference between Republicans and Democrats on willingness to accept because they feel maybe that government's forcing it, like EV subsidies, for instance. They don't want that.
Let's also talk. I want to continue talking about trust and your trust barometer. But there's New Hampshire. This is a big deal, especially because Ron DeSantis not only dropped out, but also supported Donald Trump. I mean, is there anyone that will stand up to Donald Trump?
Well, so Nikki Haley's giving it her best shot, and I think the polls show that Trump's still winning by 15 points, and so it looks as if it'll be a Biden-Trump outcome for the election.
I mean, New Hampshire, and you know New Hampshire, quite well.
Yeah, I went to prep school there.
Yeah, so it's a little bit different to other caucuses because it's actually, because of the people that can vote in it, it's more of almost like a general election. So it gives you a blueprint, not of what the Republican want, but what the wider American citizens would vote for.
Well, yeah, because, you can be a Democrat, you can be an independent and vote in the Republican primary. So, yeah, it's a better sort of view of what might happen in November. And it looked as if Haley was really closing the gap, but now it seems to be widening again.
Richard, in the last trust barometer, I think there was a lot of concerns that actually people didn't connect with politicians and definitely did not connect with chief executives. I mean, is that trust being rebuilt slowly, or is there just a fracture in society that will take years, if not decades?
So I think that the pandemic really had a negative effect on all establishment spokespeople. Whether you're a CEO, government leader, journalist, even academic, because the idea somehow that science and society have been divided is a big problem. And so a person like me is now as trusted or more trusted by someone who's skeptical of innovation than a scientist.
So how do you rebuild that trust? I mean, it seems like a bit of a nightmare, frankly.
Well, I think scientists have to acknowledge when there's a change in the science. I think we also have to have a more measured pace of adopting these innovations. We can't be seen as forcing them. And we also better consider the side effects, that if, in fact, AI is going to be implemented in the financial services industry, what are we going to do with the insurance adjusters or other people who might lose their jobs?
I mean, on geopolitics, and certainly with Israel, Hamas, and other things, the silence is deafening from chief executives. Is it just because it's impossible to weigh in, or?
I think the smart move for CEOs about Israel-Palestine is to express humanity and to say that we mourn the losses of life on both sides, that the action by Hamas was genocide with clarity, but that 23,000 people have been killed in Gaza in the aftermath, and that you have feeling for them as well, and that you want people to live in peace. But essential for the employees that they not feel that you get into politics.
There's something pretty incredible when you look at the trust index, is actually you also have a breakdown of developing countries, actually all countries, but it's developing countries that lead on trust. I mean, the difference also between the 2023 and 2024, basically trust barometer, I mean, it always has, what's the main difference that you see between the countries that are coming out Trumps? I mean, if you have an autocracy, then people believe you more.
Yeah, well, it's a sadness that not a single G7 country is in the high level of trust, and we now have the autocracies, and why? Well, because they have better economic performance. But we saw the first sign of kind of dissent out of China, which is that 2/3 of people said the government has too much influence on science. That's a big kind of watch out, because the Chinese are not happy with what the result was in COVID.
And Richard, when you look also, you have a section called Institutions Out of Balance, and the fact that governments are seen as far less competent and ethical than business. I mean, does this go back to what you were saying at the beginning? Was it COVID and the lockdown, or is it just a cycle in elections that has happened over the last 300 years?
So we really have 4 logs on the populist fire. The first is the mass-class divide in opinion. The second is the imbalance between business and government, where business is 50 points ahead of government on competence, 30 on ethics. And then the third is disinformation. And now the fourth is this fear of the pace of innovation. So the problem for government is it's seen as either paralyzed or incompetent, and neither is good. So government has to now show, for example, that it's able to achieve proper innovation, that it will support the kind of proper, structure of regulation, and that its leaders are willing to listen and be accountable.
But so if these established leaders are not listened to tell the truth, who's listened to?
Well, trust moves local. It's my CEO, interestingly. Trust moves into my company, which is why CEOs have to speak up. It's my company, my CEO, my company newsletter. And so if trust is local, then, the company has to have at least some point of view on most things. Now, I do believe that on diversity and inclusion, on sustainability, on geopolitics like Russia, Ukraine, and now on innovation, it's really important that a CEO lead the way.
And again, I mean, we're in a very uncertain year, economically, societal kind of like concerns. What do you worry about the most?
I worry about instability. I worry about everything becoming political. There's an anti-DEI movement in the States. There's a whole kind of, things are really escalating out of Israel-Palestine. And so politics invading, consumer brands, which to me is unfortunate. Brands have, tried to be part of conversations, and God knows employees are looking to their own companies to be part of discussions, because the most credible and interesting part of our study is you discuss politics more in your company, because it's the safe place to do it, not in your own neighborhood. I mean, you can't go over the fence anymore to the neighbor.
Yeah, because I've heard actually, even on our roads, some pretty big fights. Was Davos useful to you?
Davos was hugely useful for me. I learned a few things. One, that trade instead of east-west is going to be north-south. Yeah. 2, I had a real sense of the deep commitment to AI across the board, not from just Microsoft, Google, et cetera, but from companies implementing it in healthcare, et cetera. And I think, 3rd, I really had an idea that companies are really struggling to find their way in society, but they are committed to a better place.
All right, Richard, thank you so much. Always a good idea to speak to Richard Edelman, the chief executive there of Edelman. Coming up, it was supposed to be a rival to Netflix. Instead, Sony has pulled the plug on a $10 billion merger. So we have the details on what went wrong next, and this is Bloomberg. Now, it would have created a media giant with the financial muscle to rival Netflix and Amazon. Instead, after 2 years of negotiations, Sony is terminating its $10 billion merger with India's Zee Entertainment. Now, Sony says the conditions of the deal were not met and is now seeking $90 million in breakup fees, while Zee says it categorically denies the allegations. So let's bring in Bloomberg's Alex Webb. Alex, I mean, this is a huge deal. This was meant to be the game changer for the companies. So what went wrong?
So essentially, the CEO, who is also the son of the founder, was embroiled in a investigation from India's markets regulation to do with some borrowing, from some of the ways that money had been borrowed. He's not been found guilty of any of that, but for Sony, the reporting suggests they were concerned actually what the corporate governance fallout of this might be, and it seems to have been enough. They wanted the new entity, the merger of these two units, to not be led by him. Right. He clearly not willing to step down, and therefore it's falling apart. So
legally, what happens next?
Well, legally, they continue as independent companies. The struggle they have right now is that, as far as we know, though, I don't think there is an ongoing investigation into him. The struggle right now is, can these companies compete at the necessary scale, right? Because we've got Disney merging with Reliance's, or selling essentially its local units to Reliance. Reliance will control this 51% of this new entity. They're going to have massive scale. Of course, you've got Netflix and Amazon playing in this place too. India is a market which has incredibly high price sensitivity, which means you do need a huge amount of scale in order to make these things worthwhile and make them pay for themselves.
But so can they survive on their own? Would somebody else actually swoop up and try and buy them?
I mean, it's always possible. I think it's clear that Sony is trying to actually, it seems, expand its presence in this market. It was going to be the controlling entity here. It was going to have 51% of the new business. Zee, maybe therefore, is still there to play for. There are some other players in the market. There might be options, but as yet, this seemed to have been the most attractive one, and it would have given Sony, in one fell swoop, something like 75 different stations and stuff in the region. So that would have been hugely compelling for them.
So I think there's a breakup clause where they can actually try and claw back like 90 million. I mean, do we know if this is going to get ugly between the two companies, or friendly, or do we just need to see how it plays out?
I think we have to see how it plays out. I don't see much reason for... I mean, surely the 90 million one assumes will be paid. That's going to have been poured over by lawyers in very great detail. They were in a real standoff. This has been something that's been going on for a little while. We first reported a couple of weeks ago that this was an issue. It was then reported by our colleagues in Asia just 2 weeks ago that actually looked like it was going to break up, and now we have actually seen that happen. Now, the fact that it took so long suggests there was a lot of back and forth. They were trying to find some sort of resolution. Yeah. Clearly, one was not reached.
Alex, thanks so much, as always, for joining us. Alex Webb there with the very latest on Zee and Sony. Coming up a little bit later, the PIMCO co-founder, Bill Gross, speaks exclusively to Bloomberg. That conversation, you won't want to miss it. It's at 8 p.m. here in London. Up next, Bloomberg Brief with Danny Berger in London, Manus Cranny in New York, and this is Bloomberg.